The NASDAQ is trying for its 12th straight day of gains.
Bitcoin soaring to new record highs.
Elon Musk is now the richest person in the world as of today.
These markets just seem to defy gravity.
Maybe I should get into the stock market. So that's really what I expected my stock journey to look like. All these guides makes it look so easy to just put money in the stock market and get rich.
Dude, just buy SP500. Even better, just buy GameStop. That's gonna get you.
Yeah, thanks. I've heard that advice before. The problem with this advice is that it forgets about the fog that covers the pit of the unknown. There's a lot of things that you know that you don't know, but there's also a lot of things that you don't know that you don't know. So at some point you start venturing into the fog and start learning about how to invest in stocks. And you start reading about terms such as bulls, bears, short sellings, spreads, and hedges. And this is where most people fall off. People don't want to make mistakes, and they just keep pushing this decision down the road, and this circle continues to repeat. So I'm not a financial advisor, and I'm still very much a beginner in the stock market. But what I do have experience with is being a beginner at the stock market. You might have heard about the 80-20 rule. This rule says that it takes about 20% of the effort to get 80% of the output. And that's what we want to talk about today. We want to talk about those 20% that gets you 80% of the way. When it comes to the rest of the 80%, I can't teach you this. This is something that you will have to look up yourself. So with that said, let's just get started. I used to have a savings account in Norway, which actually gave me a pretty good interest rate. So I was getting around 2.8% interest in the good times. And during the bad times, it went down to around 1%. And now I'm living in Germany, and here the interest rates are even worse. Here you're lucky if you can get maybe 0.6% interest in your account. So if you have access to a high interest savings account, that's all good. But for most people, that might not be the case. And then again, you can always ask you the question, why can't I just leave the money in my bank account then? Well, yes, you can, but this is where inflation comes in. If you look at the last 20 years in Germany, the inflation rate has been roughly around 1.5%. That means that for every year your money lies in that bank account, it loses 1.5% of that value. All right, so you at least want to make sure that our money does not lose money over time, and preferably even earn money over time. And that's of course where investment comes in. A lot of people tell you this magical number that if you're investing for the long term, you will earn around 8% every year on your investment. Subtracting then the 1.5% in inflation, we're sitting left with 6.5% in revenue. That sounds great. Where do I sign up? All right, so we do know that we want to invest, but the more difficult question is, how do you do that? If you go and look at the stock market, how it was looking in the 70s and 80s, at the stock exchanges, you would see people screaming at each other. They would have their phone in one hand and they would yell out prices to each other. And this is how trading worked. But as a normal person, you didn't really have access to the stock market, at least not directly. The only way to get access to the stock market was by putting your money into, for example, a retirement fund, and that fund will invest the money on behalf of you. Now we've seen apps coming on the market, such as Trade Republic, Trading 212, Robinhood. These apps allow anybody to get access to the stock market just through their phone. So we know that we can use traditional banks to invest for us, as we have seen for many, many years, but we also know that we now have access to these new apps. And then the question is, of course, which one should you choose? So essentially you have two options. You can either go with the traditional banks, which usually charges you a flat fee for each transaction, which could be somewhere around 8 to 10 euros per trade. Or you can go with the new applications, which usually has a very low fee. A lot of them charges only €1 per trade. Another really cool thing about the app is that it gives you the control. Instead of just telling the bank, hey, execute this order for me, and you might have to wait a day or two for the order to actually be executed, you can do that in a few milliseconds on your phone. So when I was doing my research, I was convinced that the app sounded much better. I wanted to have full control, and I didn't want to pay these massive fees that the bank was charging. But my biggest concern was, is it safe? Like, where does my money go, and what happens if, for example, the company goes bankrupt? This is where you have to look into each individual app. A lot of governments will actually guarantee the money that you as an individual put into your bank account. And because a lot of apps chooses to have an agreement with a bank to handle their banking, your money is then also secured with this same security. So here in Germany, that means that if the bank goes bankrupt, up to 100,000 euros is secured. That means that you will get that money back again. This is where you need to look into each app and see if they have such an agreement with a bank. and if this bank is secured by the German government, for example. All right, so we got a stockbroker, so we can start investing. But before we do that, we need to first decide what do we invest in. There are seemingly unlimited things that you can invest your money into, but let's focus on stocks and ETFs as that's what most people will begin with. Okay, so what exactly is an ETF and how is it different from a stock? So a stock is a part ownership of a company. So when you buy that stock, you own a little bit of that company. So if this company has 1,000 shares and each one of these shares are worth $1, then the company's value is $1,000. There are constantly people wanting to buy and sell these stocks. And if people collectively think that this company is going to increase in value, people are willing to pay more for these stocks. And the price goes up. So this is stocks. But the problem for us is that we are not financial experts and we don't know which stocks to buy. For example, Google and Facebook are both within the advertisement sector, but I don't know which one is going to increase in value and which one is going to decrease the value. So which one should I buy? So of course I could start doing research about these companies. I could start reading their financial reports, what are their plans for the future, and try to gauge how they will perform in the future. But there are thousands of companies to invest in, and I don't have time to read up on all of them and try to compare them. So that's where ETFs comes in. ETF stands for Exchange Traded Fund, and is actually a collection of many stocks. Okay, so how does this work? Let's make a fictional ETF. This ETF will buy 4 stocks at 25% each. It will buy Google, Facebook, Microsoft, and Apple. Then they will create their own stock and sell this on the open market. And when you buy this stock, you are buying indirectly ownership of those 4 underlying companies that the institution owns. So if the overall value goes up, then the ETF goes up. And if the overall value goes down, then the ETF goes down. So buying ETFs is a really easy way of buying a lot of different stocks. And buying a lot of different stocks in different industries is called diversification. Diversifying across many different industries means that you're not sensitive to the fluctuations of individual companies. For example, when Facebook were facing legal actions, their stock price plummeted overnight. That means that if you were holding Facebook stock, you would have lost 10, 20, 30% of your money overnight. However, if you were owning an ETF where Facebook were maybe only 2% of their portfolio, that will have a much less impact on your overall value. Okay, so we now know what an ETF is. So then let's go back to what our friend over there was saying earlier. Should we invest in the SP 500? And what is the SP 500? The SP 500 is not actually an ETF, it's actually an index. So the index tries to give a numerical value how a certain market is performing. In the case of the SP 500, it's trying to track some of the 500 largest publicly traded companies in the US. If you're curious on which companies are included and what weight they're given, you can look this up online by just searching for SP 500 holdings on Google. That means that if you were to buy an ETF today that tracks the SP 500, 6.68% of the money that we put in is indirectly buying Apple stocks. Scrolling down the list, we can also see that we're indirectly buying 5.29% Microsoft, and all the way in the end, we're buying 0.007% of the News Corporation. So why is the SP 500 so popular and why is everybody recommending it? Looking at historical data, we can see that it's been steadily going up ever since it was created in 1957. It might go up and down, but the trend is always going upwards. If you search your broker for SP 500, you most likely find tens or even hundreds of different ETFs that track the SP 500, depending on which providers your broker have an agreement with. Alright, so where does this lead us? Well, Warren Buffett, one of the probably most famous investors of all time, said diversification is insurance against ignorance. Essentially what he's saying is that if you know what you're doing, buy stocks, because you will know which companies will do best in the future. However, if you don't know what you're doing and you're ignorant, like me, then you're better off buying ETFs because you don't know which one to pick and you should rather just follow the general market. So where does that leave normal people like you and me? Should we not invest in stocks at all? Well, no. Most financial experts recommend you to have most of your money in ETFs if you don't know what you're doing. Of course, you can always put in some of that money into stocks, but you always need to be aware of the risk that comes with it. A stock will go up 10, 20% in a day, and it can also go down 10, 20% in a day. And if you're not able to tolerate that risk, you should not be investing in stocks. Another important thing to think about is that if you already own an ETF that covers, for example, the SP 500, you already own stocks in, for example, Apple and Microsoft. Do you really need to buy more stocks in those companies? Or could you really just buy the ETF instead? Alright, so we now know that we want to invest, we have a broker, and we want to buy some stocks in ETFs. So let's just go and find some candidates. Alright, so we're finally in front of the computer and we can actually buy something. I want to take you through an example of how you could buy a stock or an ETF. I will be using a specific broker and I will be buying some specific stocks and ETFs, but this is not the ones that you need to use. I just want to take you from start to finish. What are all the important attributes that I think you should be looking for when you choose which broker to use and which ETF to buy? So let's start completely fresh. I don't own any stocks or ETFs, and I just got my broker set up and I'm ready to invest. First thing I want to do is invest in SP 500, but as we know, there are many different options. So the first thing I need to do is to look through some different providers. So the first thing I'm going to do is I'm going to go in my broker and then search which are the SP 500 ETFs that this broker supports. All right, so we're now in the broker, and this is actually a paper trading account. So this is not real money, but it's a great way to get to use a platform and also get a feeling on how to trade. So the first thing we want to do is to find out which S&P's indexes this specific broker supports. So I will search for S&P 500, and as you can see, we get a massive list of different potential ETFs that we can buy. And then of course the question is, which one do we buy? There's a lot of different information that you can see here. We can see the different providers. We can see that Vanguard, iShares, Investico, HSBC, SPDR, and so on. These are different providers. These are companies that have bought the stocks and are now selling ETFs. The second thing we see is what it's tracking. Here it says S&P 500. And after that, we can see a lot of different information. And this is where things can get quite complicated. I won't be going through all of the different types of ETF funds that can exist, but I wanted to at least cover the most important ones that I think that you should look into. So it doesn't really matter which provider you choose. There are some different attributes that will matter, but you will have to look into each provider and that specific ETF to see how those other attributes weigh up against each other and then make a decision out of that. So as an example now, I want to go into my platform here and I want to choose this iShares SP 500 ETF. And as I can see here on the left, you can see that these are the abbreviations of these different ETFs. In this case, it's IVV. So if I want to look up this ETF, I would just simply type in iShares IVV. And I will quite immediately find the specific ETF that I'm looking for. So here I can look up all the information I need to know about this ETF. So the first thing I would look at is the performance. How has this ETF been performing in the last couple of years? So I will go to performance, and here you can see the average return from 1 year, 3 years, 5 years, 10 years, and since the ETF was created. So as you can see, in the last 10-year period, this had an average return of 13.83%, which is actually pretty good. I can also see how it's been performing per calendar year. So if you go to calendar year, I can see, okay, in the year 2020, it was an average return of 18%. In 2019, 31%, which is extremely good. But in 2008, which was a very bad year, it was actually minus 4%. And this showcases again the importance of holding ETFs for a longer period of time. There will be years where you actually lose money, but then over the long term, you will eventually earn money. Another important thing to think about is that the ETFs are not actually completely free. The company that holds them actually wants to earn a little profit, and they do that through the expense ratio. If you go to fees, we can get to see here what the fees for this specific ETF is. In this case, it's 0.03%. This is usually around what you can expect for an SP 500 index. This means that every year they will automatically take out 0.03% of the value of the ETF that you hold, basically to pay for their services. But you don't need to worry about this. This all happens automatically. Another important thing to think about is which currency is it hosted in. So in this case, we can see here that it is covered in the US dollar. That means that when you're buying this ETF, if you are coming from a different currency, for example, the euro, you're actually also indirectly buying US dollars because you need to buy US dollars to buy this ETF. And that means that you are actually also sensitive to the fluctuation between the dollar and the euro. So if the dollar goes up afterwards, you will actually also have a profit in the sense of the US to euro exchange rate. However, if the dollar goes down by the time you sell it, you will actually lose money in the currency exchange. So at this point, you might be thinking, okay, I don't want to deal with the whole currency exchange problem. Let me just find an ETF that is in euros. That would make sense, but the problem is, for example, in the SP 500, the underlying assets are actually in dollars. So you have to remember, what does the ETF actually contain? Well, it contains many different stocks. The thing to keep in mind is that all of these companies are US listed companies, and all of these stocks are in US dollars. That means that even if you're buying an ETF that might show up as euros on your broker account, you are actually essentially buying US dollars. Some brokers will actually show you this difference. So if you buy something that is listed in dollars, they will show you how much have you earned or lost in the currency exchange. However, some brokers will actually hide this information to keep the user interface easy for the user to understand. This is a quite complicated topic, and I don't think for most people it really matters, because for a lot of us, we want to invest in the US market because that's where a lot of the big companies are. There are, of course, techniques you can use to kind of balance this out, and this is called hedging. But this is a topic that I won't get into today. The last thing I want to have a look at is which stock exchange is this stock actually hosted on. And I can look that the SP 500 index that we look at here is listed on the New York Stock Exchange. As you can see in this broker, we also have some options that are listed on the London Stock Exchange. So why does that matter? Well, stock exchanges are located in physical locations around the world. And the stock market is usually open around 9 to 5 in that local time. That means that if you're buying a stock that is listed on the German stock market, it will open at 9 o'clock German time and it will close at 5:30 German time. However, if you're buying something on the New York Stock Exchange, it will open in those hours but in New York time. In the end, it's not super important because you can always send in an order before the stock market has opened, and then it will just execute as soon as the stock market opens again. However, if you are a person who likes to keep a little bit of an overview of how the stock market is performing, you might want to choose one that is open in the hours that you will more regularly be trading. Okay, so these are the most important attributes that I will definitely look at before buying any stock or ETF. So let's go in and actually buy an ETF. Alright, so you're back in the broker. As I said, there is many different options, but as an example, let's just pick the first one. So this one is from Vanguard and it's tracking the SP 500. It is currently trading at £51 per share and it's traded on the London Stock Exchange. If I now click on this, I can then open this chart and I can see how it's been performing over time. However, there is one thing that I want to make you aware of. You might see these big dips and think, oh no, this was a huge sell-off. I should have bought here, but now it's too late. This is why I want to make you aware that it really depends on how far zoomed in on a chart that you are. If I now, for example, zoom out to the weekly chart, you will see that this actually are just some minor dips in a bigger picture. You can see that there was one massive dip here, and this is actually in March 2020, which we all know was during Corona, where the market sold off about 30% of their value. However, you can also see that it quickly recovered from that, and now we're much higher than it was even before Corona. So what do I mean by this? I mean that it's not really important to find the perfect timing. You might see that the price was a little bit lower yesterday, but in the big picture, it doesn't really matter. So whenever you feel ready to invest, just invest and don't think too much about the timing. So that leads us to get to the fun part, which is actually buying the ETF. And in most brokers, it's quite simple. I will just go on the buy button here and we'll get up to prompt how many shares we want to buy. So as you can see, the stock is roughly trading at £51 per share. That means that if I wanted to invest around €1,000, that would mean, yeah, let's see, 20 shares gives us 1,100. Okay, let's try 18. Yeah, that's around €1,000, and that's what I'm willing to pay at the moment. So I will just go to the review order and I will send a buy order. And we can see that it will immediately place the order, and hopefully in just a few moments, the order will also be processed. And there we go, we just got the order filled. We can now see down here that I own 18 shares. This was the price that I paid. This is the current price, and this is the market value. You can actually see that I'm actually down a little bit. And why is that? Well, that is because of the difference between the ask price and the bid price. What are somebody willing to pay for it, and what are people willing to sell it for? And there will always be a slight difference between them. And this is why when you immediately buy something, you will always be a little bit in the minus. As time progresses, you will be able to see, if we go now back to the minute chart, we will be able to see, if we zoom in a little bit, that this green line is where we bought it. And that's really it, and it's not more complicated than that. I know that putting money on the line can be quite scary, and that's why I would always highly recommend you to try one of these paper trading accounts for a little bit, just to get a feeling on how does it feel to click that buy button and what you do when you see suddenly that your money is going down. So if you ask for my recommendation, which you by the way shouldn't because I'm not a financial expert, but if you still do, my recommendation would be to just invest a little bit, just in the start to get going. It is the scariest the first time, and the second time it will be much easier. I would recommend to just simply buy one of these big ETFs. The SP 500 is a great place to start, but there is also other options, so don't just invest in the SP 500. Once you have invested in one ETF and you feel comfortable with that, you might start to want to invest in multiple ETFs. This is where things get very individual for each person. What's your risk tolerance? How much money do you have to invest? For how long do you want to invest? And how much time do you want to spend on this hobby? All of these questions comes into how you should invest, and I can't tell you how to do that. This is something you need to figure out. If you're like me, you actually find this quite fun. And that's when you start wanting to learn more and more and more. And that's where you can get into technical analysis and learn how to read the charts and figure out when is the perfect entry point of investing. And I might make a video about how to do some technical analysis, but I will leave that for next time. But in the meantime, my challenge to you is to go and invest, even if that is a single euro, but just to get started. So as Ronnie Coleman said, ain't nothing to it but to do it. So I'll see you on the stock market.
Ain't nothing to it but to do it.